Hey everyone, welcome to Solving the Riddle, the podcast that unpacks the financial puzzles shaping your future. I'm Andrew Whitewood, and together with Alec Riddle, we explore the ideas, behaviors, and strategies that help people make smarter financial decisions and build lasting wealth. Hey everyone, and welcome back to all our viewers and listeners to another episode of our podcast. Alec, the feedback has been absolutely amazing, and all the engagement that we've actually been participating in. The last podcast episode, we had Valdu from Peregrine Capital, where we unpacked hedge funds. But I think the key thing today, Alec, is we want to unpack the questions that we are facing on a day-to-day basis when it comes to financial planning, right? Financial planning is very fluid. It's always evolving. And our clients are always posing us questions. I think it would be very valuable today to unpack some of those questions for our listeners and viewers.
And before you do, can we also just encourage our listeners and viewers, if you've got any questions, drop them in the comments. We'd love to answer some of those questions for you. Any burning question you have, no questions too stupid. Send us some questions. Let us know what you want to know. We'll try and attempt to answer those over time.
Most definitely, Alec, and thank you for that. I think the key question that's burning at this point in time, right, Alec, is the tax-free savings investment world. A lot of people are accumulating and starting to save into a tax-free savings investment, but a lot of those investments are sitting with their banking provider. And I'd just like to pose the question to you, Alec, is that right or wrong? What are the options that are available to clients and investors out there with regards to their tax-free savings investment?
Well, incidentally, after our first episode, which was on the budget speech, and we spent a bit of time on tax-free savings accounts, one of the questions was, should I invest in a tax-free savings account via my bank? Now, there are advantages and disadvantages, I do believe. Obviously, the advantage is it's probably quite easy to do, but one has to be careful of perhaps the portfolio being too conservative, cash-orientated. Your tax-free savings account, because all of the growth is tax-free, you actually want to be targeting massive growth. So you ideally want to be targeting either offshore or that type of thing. Obviously, we spoke about hedge funds in our last episode. Can't have a hedge fund inside a tax-free savings account.
Because of the performance.
Yeah, so that's very important. But the biggest negative to me for most of the products with for example, the bank tax-free savings account is there is no beneficiary nomination allowed. So what that means is that you build this tax-free savings account, it grows to 300,000, 700,000, a million, whatever the case is, and somebody passes, it doesn't get to the intended beneficiary straight away. It has to go via the estate, and then, of course, that's a whole process on its own.
12, 18 months.
And we'll talk about estates and wills in a future episode. But that could prolong the issue there. Your thoughts on that?
Alec, what I'm seeing when I'm engaging with clients is that people default into that conservative investment strategy, like you rightly pointed out now. And clients come, we create this holistic financial plan, we speak to the whale graph, we create all the scenarios, and then the clients are asking me and pointing out to me the fact that, okay, so now you're advising me on all my investments, for example, and then I have this conversation with the client to say, but you're invested in cash, or a cash-like engine, for example. So if you think about it, you've got your chassis, which is your tax-free savings investment, but the engine within is like 1,000 cc. In all fairness, they should be investing in a 2 liter, for example, Alex. So totally agree on that point with you that the key thing is you should be investing as aggressively as possible. You need to be investing in growth assets. You need exposure to shares locally or offshore, in my humble opinion, within a tax-free savings investment.
Yeah, and I would say about 90% of my clients in tax-free savings accounts are invested in offshore feeder funds. Part of the reason for that is obviously, and one of the other questions we'll touch on, is this a good time to invest offshore? But we'll elaborate on that question. But why offshore feeder funds? Well, diversification. So not only diversification in terms of currency, but diversification in terms of geographical areas, companies that you can invest in, protection against South African risks. All of those type of things, having exposure to the dollar or the pound is very important. Let's move straight into, is it a good time to invest offshore?
For sure, yeah. So Alec, It's impossible to time the markets. I think that's the starting point, and thing that I would like for us to flesh out is it's never, no one has a crystal ball, and sometimes people are going to point out that it's a good time to invest offshore in their opinion, and it's not a good time to invest offshore. But the key thing to note is that yes, we're taking our rands offshore, for example, and we could invest in dollars, GBP, pounds, euros, etc. But the key thing is that yes, you're going to hold your investment in hard currency. The key thing is though we are looking for that diversification. But I know we've done a hell of a lot of research with regards to timing the currency, okay? And there's never a perfect time, and that's kind of like where I was going to start at, but I wanted to give context, is that we're not here to say that we are going to time the rand dollar exchange rate, for example. And the key thing to note is that you could wait, okay, and try to time the currency so the rand strengthens. So for example, the rand versus dollar goes from 20 to 16, right? So we've called that the currency fluctuation spot on. But Alec, I know, and I'm going to throw this to you, we've done a lot of research on what happens in investment markets when, for example, an investor waits for the currency to strengthen, come back from weak levels. But then what, for example, is happening in the S&P and the NASDAQ and other global markets in Asia and Europe?
Yeah, absolutely. So, you mentioned timing the markets, and I learned this from Andrew Bradley when I first came into the industry, and he's, well-respected individual in financial planning circles. And one of the first lessons I picked up from him was it's about time in the markets as opposed to timing the markets. So you've got to get into the market. So that's very important. The second thing is, before I go into answering your specific question, what we need to understand is that the rand was launched in about 1961 and used to be able to get $1.60 per rand, okay, and how it's depreciated over time. For me, there's a specific date, August 92. I've mentioned before, I took an athlete to Japan and he won $50,000 at 2 Rand 73. Okay. But the important thing is here, from 1961 until 2026, the rand is depreciated on average 6% every year.
On an annualized basis, yeah.
If you look at the short-term window, the rand has strengthened over the past 12 months, probably in the region of about 10 to 12%, whichever day you look at it.
It's fluctuating on a daily basis, yeah, but it's shifting all the time.
Now, so a year ago, you might have said to somebody, let's invest offshore, based on the fact is, over a 60-year period, the rand depreciates by 6% per annum, and suddenly the rand strengthens. Well, was that a good decision or a bad decision? Well, while the rand strengthened, and the perception is now you've lost a little bit of money, the offshore funds have risen.
So the underlying assets.
So the underlying assets have risen. And I'm going to give you a great example. So let's talk about COVID. So during COVID, the rand blew out to 19. Everybody was scared to invest because they didn't want to invest offshore because the rand, it was so expensive to buy a dollar. But I remember an actuary phoning me from Cape Town, one of my clients, and he said to me, Alec, I've got some spare money. Isn't now a good time to invest? I said, it's a great time to invest. Now, bear in mind, the rand had blown out from 16 to 19, just a very approximate, that's about a 20% weakening.
Take, yeah.
Okay, but the offshore markets had dropped over 30%, so you were getting a 30% discount. So the net trade-off was that you were getting in a 10% or more cheaper than the person who invested when it was 16. So, yeah, so it's all of those type of things. So is it a good time to invest offshore? Absolutely. Where the rand is sitting now, it's a very good time. And whether the rand weakens in the next month or two, it will still be a great time. The important thing is, as Andrew Bradley said, time in the market.
You've got to have a 30-year time horizon, a 30-year view. And speaking about the rand volatility, just fluctuating. And I think that's the next topical question that we are being posed with at the moment, Alec, and I'm going to throw this into your court, is the Middle East crisis that we are facing at the moment. There's a lot of volatility in investment markets. The US market closed at a record high, the S&P over 7,000 yesterday. Month to date, I think you shared with me, US markets are up 15%. Okay, but how are you dealing with clients on this topic? Are clients picking up the phone, a dime a dozen, and phoning in and asking you what's happening? What's happening from a financial planning point of view around this crisis?
I think the important thing is to set appropriate expectations. I remember when I first came into the industry and the training I got was flawed, I think. You were trained and said, well, if the 1 year return isn't good, focus on the 5 year return. If the 5 year return isn't good, focus on the 3 year. But then you anchor the client on those great returns. Yeah. That's the expectation. So as soon as the market turns, the client panics. So it's important to set appropriate expectations. Let the client know that over the long term, you are going to get great growth. But there are going to be periods, and I remember in 2008, during the global financial crisis, telling a client that if we invest in this way, the chances are that in a good year, we could get 20 to 30%. In a bad year, we could get minus 10 or minus 11. But on average, we're going to get in the region of 9 to 12. And he was happy with that explanation. A year later, the global financial crisis, markets had crashed around us and whatever. And we had a review, and I sat down with this client and he asked me, remember those bands you said, minus 10 to plus 30? Are we within those bands? And I said, yes, we are. And he said, well, that's great. That's all I needed to know. And so the expectation had been set. So when we have tumultuous markets or geopolitical risks like we're experiencing right now, and yes, there's been a nice rebound, the last few days a week and so forth, but it's nervy for people. When I speak to people in public, that we haven't had a single client phone us. They just are comfortable with the portfolio construction, with the expectations that have been set, and we tell them we are investing for 10, 15, 20 years, long-term horizon, and then you take out a lot of that risk because the volatility risk is essentially emotional, unless you're drawing from a living annuity. We've spoken about that. But it's all about emotions. You've got to control emotions, the noise. And hopefully we're going to get Bruce Fordyce on as a guest one of these days to talk about the Comrades Marathon story. Why do most people, 90% of dropouts or 80% of dropouts happen in the Comrades on the uprun of poly shorts? I've run the Comrades uprun twice. It is the smallest hill on the course, but it's because that's where all the noise is. You are dehydrated, your glycogen depleted, you see this massive hill, you've got no energy left, and you think it's unconquerable, and people quit.
It's like the Ironman analogy, Alec, and the Ironman just happened a couple of weekends ago in Port Elizabeth. And the key thing is some of our clients compete at the amateur level in the Ironman, and they always relate it back to their personal circumstances. I had a meeting recently where I was going through the likely range of returns. You mentioned the bands, the recipe, the asset allocation, etc. And this lady sat here and she said, it's like me sitting on the bike for 6 hours. I've just got to get into my zone. I've got to focus. It's dull and boring, but I've got to sit tight. And I was like, wow, my job is like done here. Let's go, But the key thing is just for people to understand and for them to actually relate it back to their personal circumstance. And that's a big part of our show and our podcast is that we want to relate these things to personal circumstances, personal experiences. Like you say, Bruce Fordyce, we hope to have him on the show in the future. The Comrades Marathon, the Two Oceans example. There's people all very active, but you need to understand, take the explanations and the information and the learnings from the show and apply it to your actual life and to ensure that you stay committed to your strategies in different phases or different spheres of life, Alec.
One of the questions we had, and what's very important is people who listen to or view the show are, we encourage them to see a financial planner, but many of the people are going to try and do it themselves. They might perhaps open an easy equities account and so forth. One of the questions is, if I open such an account, am I looking at active or passive as a manager? Perhaps you want to touch on that.
Yeah, so that's a great question. It's quite technical, so I'm going to try to keep it as simple as possible. So if you speak, let's start with passive investing. So passive is not necessarily as passive as you think it is. So passive, you track a specific index. So if you think of an index, it's a predefined basket of companies, okay? And then you put your $500 in, you put your 10,000, 20,000, whatever the amount is, Alec, and now you day on day track that specific basket. Okay, but why I say it's not really a passive investment strategy or decision is because you as an investor need to decide which passive basket or index you track. Okay, so that's an active decision. Okay, we're not saying we're against passive investing because in the solutions we use, Alec, we have exposure to passive investments. So we do get exposure, so call it market exposure. Valdo in our previous episode referred to it as beta via passive investments, the S&P, NASDAQ, etc. And then you also get more actively managed ETFs where you get managers that are adding a bit of an active overlay. And that's what I'm going to explain now is where we step to the active side is where you have have managers and people that are doing research on companies, doing research on businesses, geographies, etc., across the world, locally, offshore, and they are picking specific stocks, picking specific companies, etc. But I personally don't believe that one is necessarily better than the other. There are benefits.
A blend of the two.
100% correct. I think you need to blend these. And that also feeds us back into the conversation that we had with Voldu a couple of weeks ago, is that you need to blend all these different managers, styles, ways of managing money. It just speaks to diversification. The way we manage money for clients, Alec, you've got one egg, call it 5 million rand, call it 100,000 rand. But that egg is split into many different eggs. And the way I explain it to clients is 1 or 2 eggs over time. If you've got 100 eggs, you might break an egg. It might go fraught. For example, the Steinhoff debacle, the African bank debacle. But the key thing is there's so much diversification there that the likelihood of us helping that client into retirement and once again over the finish line is just, the probability of success is through the roof, Alec.
Yeah, and I think one of the things about passive, let's just use, for example, the offshore top 40 index. So you have a company that's born and it starts to grow. It is not big enough to be in the top 40. The majority of that growth happens in the first few years. It then gets big enough to be included in the top 40, but you might have missed out on a lot of the growth. The flip side is true. You have a company at the top of the top 40 and it starts to lose its way. And suddenly it starts to drop. And you've actually got to watch it drop until it goes below number 40 and exits that portfolio. So those are some of the flaws. There's many positives. So there's good and bad with everything. It's important to know what is out there and so forth. You mentioned Steinhoff just now, but I can remember, I think it was December 2017 that it happened. There was major panic throughout the country. Pension funds were affected. Most fund managers had exposure to Steinhoff in their balance funds and so forth. And I remember one of the first things we did is, because we would need to have a discussion with clients when we did our review meetings or whatever and say, well, the good part is that in this balance fund, our net exposure to Steinhoff was, for example, 1%.
Or
right?
Even less, Alec. Totally
Yeah,
agree.
or even less. And, the portfolio would have done 11. There's a little bit of reduction because of the exposure to Steinhoff, but we still managed to get you 10.5% as an example. And that is the importance of not having too aggressive an opinion on any one fund or company or sector.
So adding to that point now, Alec, a question that I regularly get with clients is they're saving up, for example, in their bank account or like in an interest-bearing account with their bank. And now do they start contributing with, for example, a big lump sum? Or should they start paying themselves first with a monthly contribution?
Yeah, well, I like that word, paying themselves. So if you think about it from a budgeting point of view, right, this whole world is set up to get your money, okay? So all the marketing is done to get your money. And many of these marketers, I remember seeing a show on American motor manufacturer where they have psychologists who are targeting the kids for the parents to buy that particular car. So the marketing is done through the young child in the car or walking through the garage, whatever the case is, sales place, and they will be the people influencing the parents. So there's a massive marketing drive out there to get a portion of your spend. So if you don't take control and start paying yourself first, who's getting paid? The landlord for the rent, the grocery store for the groceries, the bottle store for whatever you need over there, and so forth. And you pay all of these things out and you say, oh, well, I've got, call it 1,000 rand left at the end of the month. And now you go out to eat and you haven't saved anything. So to pay yourself first is the most important thing that you can do. To start putting money away, pay yourself. Let it be automated. And that's why I like the monthly contribution as opposed to the lump sum. Because if you try and save it up, it's going to disappear into thin air. Believe me, temptation will get you. With these marketers who are out to say to you, if you buy this, you'll save that. Well, there is no saving. There's a bit of a discount, but it's all factored in. So, people love it. Oh, I saved so much. I went and I bought this thing because it was 30% cheaper. You haven't saved anything. So the important thing is to pay yourself first. So have a little list, your budget, pay. Tandu, 500 Rand, right? Entertainment, 500 Rand. And then rent and so forth. And then you are taken care of. And whatever that number is, we're not talking specific percentages or amounts. I'm just giving a very simplistic example to pay yourself first, do it monthly, sign up a debit order, because research shows that after 3 months, you forget you've got the debit order. I asked somebody the other day, they are still paying...
You see how we both set up there?
Yeah, they are still paying somebody on a debit order for something they stopped 3 years ago.
Yeah.
It's crazy.
So prime example, Alec, and you can see how passionate we are about this, everyone, is that Lynn's my wife, and we started tax-free for her not too long ago. And I showed her a recent statement, and she's like, how do I have so much money in my tax-free savings investment already? And that's the power of automating things. That money just comes off her account into a tax-free savings investment. We've set up for Scarlett and Mackenzie as well into a unit trust investment, for example. But the key thing is pay yourself first. It's all about routine, like you say, Alec. Automation in this day and age, paying yourself at the end of the month, I have never, ever seen it work.
Well, I mean, I'll give you an example. 20 years ago, a friend of mine, and we invested, he had 5,000 Rand a month spare, and he said, I want to start some savings plan. It was 5,000 Rand a month. 6 months later, we were at a braai, and he said to me, by the way, is that investment still going? I said, yeah, it's going. He says, that's amazing. I don't even miss it. 5 years later, I phoned him and I said, in 3 months' time, you will have 500,000 Rand from 5,000 Rand a month. Crazy. And he didn't even know he was spending it because it was automated.
Yeah.
And he was paying himself first. Let's move on to the will. People often ask, people don't even have a will. That is the most dreadful thing you can do to your loved ones, is to not have a will and to die intestate. That is the worst thing you can have, because if you've got minor children, money is going to go into the government guardian fund, and you know what could happen there. Well, at the best you'll get is about a 5% return, but then it's very difficult to get the money out. But the question we often get asked, I had a will when I got married. I've now got 2 children. It's 16 years later. Do I need to update my will? Do you want to touch on that?
Yeah, so it's a great point, Alec. I'm speaking to a lot of people out there at the moment, friends, colleagues, people I haven't spoken to for or a long period of time now. And the key thing is that certain people don't even have a will, which is a big concern. And it's easy to get a will drafted, get it signed, get it witnessed. Just got to do it properly. But the key thing is you don't need to go to these big institutions. We would advise that you go to a smaller, call it more boutique, like an attorney firm, for example, because you're going to get a better experience, especially when their estate is wound up. And your will can obviously be customized to your needs. But the key thing, Alec, is also a lot of people out there also get married. Okay, they do draft a will. But a lot of people perceive a will to be a static document. A will is not a static document. It's a fluid document. It can change. You can add or addendums, codicils, etc. It can be amended over time and many different times. And your personal circumstances are always changing. For example, from a wealth point of view, children, etc. You can have a testamentary trust added to your will. The key thing to note is, from my personal experience, Alec, is that it's not a static document. It's a fluid document. We deal with a couple of attorney firms nationally, because obviously we've got clients in Port Elizabeth or Gqeberha. We've also got clients in Cape Town, Joburg, etc. But the key thing is, number one, to have a valid will, to have a will that's valid. In our opinion, not with a large institution. Key thing there is customer service, customization of the wills. And then 3 is we review wills probably annually. We just touch on it. Doesn't mean that we're making changes to the will every year, because yes, you go through phases where a will doesn't need to be changed. But the key thing for me in a big event with a lot of people that I'm dealing with and engaging with at the moment is they have children, right? And there's an inheritance, and maybe now they want to set up a family trust, for example. And how does that impact one's will, or the testamentary trust, Alex? So the key thing is it's a fluid process from my point of view.
So let's just touch on that a little bit more and bring in the question, or another question, how to avoid 20% estate duty.
Oh, it's a great question.
So let us talk, and here we're talking about perhaps a family that's got more than sufficient, okay? And on the first dying, there's an estate duty abatement of 3.5 million rand. And if you leave the money to the spouse, there's no estate duty. So generally, what is the norm or the default? Leave it to the wife. But if there's enough capital, leave some or all of that 3.5 million rand to the kids and let the growth take place out of the estate. Because if you take 3.5 million and we use the rule of 72, which means that money will double every 7 years, so 3.5 becomes 7, 14, 28 in 21 years' time. That 28 million has taken place outside of the estate. There's going to be no estate duty on it. Whereas if you'd have kept it inside the estate, your estate, you hadn't distributed in terms of the primary abatement, then there would be estate duty on that. So let's touch a bit more on that, how to avoid 20% estate duty. I've just given one technique. Perhaps you want to just give it, Jim.
Yeah, no, of course, Alec. And I think the key thing there is also how you invest money, right? So, for example, you've already spoken to Mr. and Mrs., the Section 4A abatement, 3.5 million each. So, number one is also to split assets between Mr. and Mrs. There's a lot of benefits to that, okay? The second one, in my opinion, is that what you need to do is you need to look at how you are investing. So how you are accumulating assets, okay, and then also post-retirement, okay? Vehicles like a retirement annuity, for example, and then when you retire, a living annuity, that sits outside of one's estates. And a lot of people think that a will governs all of their estates. No. So the key thing is a retirement annuity vehicle has a lot of benefits for accumulation of wealth, okay? The growth within a retirement annuity, for example, is tax-free. But that asset sits outside of your estate. There's no estate duty.
And all the growth.
And all the growth. No estate duty at 20, 25%. The exact same thing is applicable to a living annuity. And we're going to unpack that in a little bit more detail in future podcasts. But a living annuity is probably the most efficient investment vehicle from a wealth transition point of view, because it sits outside of the estate, the growth is tax-free, and you've got beneficiary nominations that are acted on within probably maximum 2 months, Alec.
I had a client see me the other day and he said, listen, I've got 20 million. I read about this estate duty. I'm a bit worried, 20%. I said, hang on. Your property's worth 3 million. You've got about 3.5 million rand in discretionary capital. That's 6.5 million rand plus your motor car. You're under 7 million rand. The other money is sitting in a living annuity outside of the estate, as you said. But touch on the retirement annuity and the beneficiary nomination. We are going to do an episode on beneficiaries, beneficiary nominations across the whole spectrum. But today I just want you to bring up a retirement annuity, the misconception of the beneficiary nomination.
Yeah, so like you say, Alec, and rightly to all our listeners, viewers, and clients out there, it is quite technical. But in the past couple of weeks, I've engaged with a couple of clients, and I've had to explain that, number one, call it a retirement annuity, but it can also apply to a preservation fund, Alec, work retirement fund, etc. It sits outside of your estate, just like I said now, so it's not distributed in line with your will. Okay, that's number one point that we need to start at and understand. Then number two, everyone submits a beneficiary nomination form, or they should have. Okay, and they've nominated their wife 80% and then 20% to go to a major child, for example. So the trustees of that retirement fund have the final say at the end of the day, and they will take into consideration your beneficiary nominations. But it's not to say that the assets sitting within a retirement annuity or a preservation fund or your work retirement fund are going to be distributed in line with your beneficiary nominations. It's a key thing to understand. And Alec, we've had some bad experiences, and I say bad experiences because unfortunately the trustees haven't distributed in line with our financial plan. So we've had some harsh learnings. We've tried our best to do the right thing for our client. The money didn't end up necessarily in the wrong hands. It's just certain beneficiaries got some more than others, which negatively impacted, for example, the surviving spouse.
Absolutely. Right, so a nice little closing question for today. Somebody said, I'm drowning in debt. Help.
Yeah. So that is a challenge. I think that speaks back to your previous point, Alec. We live in a world of instant gratification. Especially with the younger generation, there hasn't been any like major events or challenges that they have really gone through in life. And I'm speaking major challenges like living after a world war, like World War II. I always speak to my mom about living in the UK post the Second World War and those tough times. It was super tough in the UK, but I think it taught them and that generation a lot about money and how to survive and how to be frugal, Alec. And unfortunately, you mentioned that we are targets, right? It's so easy. Every time I get a phone call, spam, if I pick up the phone, it's people offering me another credit card, extending my limit potentially on my overdraft facility.
Upgrade cell phone.
Yeah, they don't even use. But the key thing is you get caught up in this cycle, okay? And the institutions out there that are offering you this debt, for example, Alec, it's the interest rate charges, it starts at 16, 17, 18%. It can run into 20 to 25%. Okay, the long-term annualized return that we could reliably give to a client over time is probably 10 to 12. In my mind, that puts things into perspective. It's only one person winning here. And yes, people are drowning in debt. But Alec, I'd like to throw it back to you. What measures, what action could people take in order to start trying to get themselves out of debt? Almost like, and we could unpack this in more detail in a future podcast, like detonation. How do you get that positive snowball rolling and working in your favor?
I think the important thing is that if you are drowning in debt, do not take on any new debt. You think to yourself, well, if I can just get a little bit more access to credit now, I can relieve a little bit of this pressure. It will never work. So you have to take stock of your situation, and you have to put your cards on the table. And sometimes it's difficult to talk to a second person about that. But if you could pluck up the courage to do so, there's somebody who's going to hold you accountable and encourage you through this process. But let's say you're going to try and do it on your own. The important thing is to write down everything that you've got, all of the debt. And as I said earlier, pay yourself first. Maybe we don't have room for that right now. But maybe there's something that you can give up for a month. Or maybe there's something that you can sell out of the garage to raise a couple of R100 or R1,000. Take the smallest debt, the smallest payment. So let's say that you've got a clothing account that you've got to pay R250 a month for the next 6 months, right? And you manage to get R1,000 from somewhere. Put that R1,000 into that debt. And 2 months later, that debt is paid off, 1,000 plus the 250 plus the 250. So after 3 months, that debt is gone. The next debt, which is costing you 500, you roll the 250 over to that 500, and now you still had, because you've paid 3 months of 500, you've still got another 3 months of 500 on that one. But now you're paying 750. So that's only going to take 2 months. Now you're into month 6. You freed up 250, you freed up 500, you got that 750, and now you start to add it on to one of the bigger ones, which maybe was 1,000. And that 1,000 was going to take you 12 months, but we're 5 months down the road, and instead of paying 1,000 for 7 months, we are going to pay 2,500 for just short of 3 months, right? So now we're 8 months into it, we've eradicated 3 of our problems. Now we maybe take a pause and we reward ourselves. Let's do something special. And the next month, you start again. You hit the next one. That it's the power of compounding in your favor as opposed to the bank's favor. So think of it like this. You get a snowball. Unfortunately, South Africa is not a good analogy for a snowball. But if you've seen the pictures, a snowball, as it rolls down the hill, it will gain more and more snow and it will gain more and more momentum and speed. But having debt is like trying to push a snowball up the hill. It will gather more and more snow, and eventually you will not be able to push it. It will roll over you, squash you, and that's it. You're finished.
And I totally agree, Alec. I think the key debts that are killing people are those short-term, expensive debts. We're not speaking necessarily about a loan or a bond on your house, for example. There are ways that you can pay off your house, obviously, quicker, which you can always help clients with. We can help clients with this detonation conversation. And I know over the past 15 years, I've worked with you closely, as you know. But the key thing is we've helped people through these situations. Like you say, we've helped them see the light, get to the end of the tunnel, and then they started investing. They've got themselves up on both feet, they're creating wealth, and they're on track to experience a successful retirement.
The ones I feel for, domestic workers. I mean, they only earn a few thousand a month. How do they get credit that the repayments are equal to their salary? Okay, it's got a lot better now with more regulation and so forth. But I can remember a few years ago, maybe more than a few years, but having to help our domestic who was, say, earning a few thousand a month, but they were about to repossess her TV, repossess this, whatever, because she couldn't keep up the payments. So I went in and I negotiated a settlement, and I said, okay, fine, you can pay this off over 12 or 24 months, but please don't fall into this trap again. So those are the things. Just be careful of what you're doing. Pay yourself first, and so forth. But those are our questions, often asked questions, some of the questions we've been asked. As I've said previously, we'd love to hear your questions. So let us know. Wherever you get your podcasts, be it Apple, Spotify, YouTube, there is a comment section. Please leave us a comment, maybe a word of encouragement, whatever you want to do, or a question. We'd love to hear from you. You want to say anything in there, Andrew?
Just in closing, please don't forget to like and subscribe, Alec. I think the key thing from our side is we want more and more subscribers. The engagement has been absolutely amazing, but yeah, we want more and more subscribers going forward.
Yeah, and a big thank you to the media company, Ready Aim Fire, Jeremy and Tando. We appreciate your guidance and everything. It's wonderful working with you guys.